Hello, everybody. It's me, the Boss Hog, and we're going to look at my stock portfolio as of the 12th of February. This should really be the end of January, but I've been unwell, so this is the best I can do. But let's do it all the same. All right, so first of all, I use a Google document to keep on top of my portfolio. That's because it's spread over three different accounts, two tax efficient accounts called ISAs for those who aren't British, as well as a general investment account. So I basically put all that in a Google spreadsheet that I made, and that gives me, the reports I need to do these videos. But it does mean that because of the fact it's like dynamic and it constantly updates, even on like, in the evening when the markets are closed, it'll keep track of FX rates and things like that, right? So it means I haven't got a particularly clean end to the month. The exception is sort of the calendar month for the total when I have the ability to kind of do day end figures. Now is about all I managed to do. So the January figure here that I've highlighted yellow, that is an accurate figure. Everything else here is going to be taken from a moment in time, which is basically the end of the 12th. So bear with me this month. Life rather got in the way. So in terms of my January performance, it felt okay. About 10 days before the end of January, I was feeling actually really good because I was still staying green. My value shares were kind of supporting me. The full pullback of the S&P, where I'm a bit underweight anyway, hadn't really happened, and so it was going okay. But then toward the end, basically the market caught me as well, so I finished down about 3%. So it was still okay, but I thought it was going to be a little bit better. But that's the nature of things. February so far is off to a really good start. However, like this figure, it looks really good because obviously you're up 2.5 grand already. But honestly, like that entire profit is basically National Express. My US holdings, especially, are really struggling at the moment, as I suspect anyone is who has significant US exposure. My UK shares have been doing really well, and as we'll see in a second, the FTSE has been massively outperforming the S&P 500 for a couple of months now. And that's really part of the wider rotation away from sort of speculative stocks, I guess, tech stocks certainly, into sort of value shares. And like the FTSE has a good amount of value in it. High dividend payers, not because there's anything wrong with them, but just because they're throwing off cash and no one wants to buy the shares. So there's definitely money to be made at the moment, and gradually people are realizing that. I'm at nearly 70% in my portfolio in UK shares at the moment, and that's mostly just because I haven't really been able to find much value in the US side of things, so I've just been gradually buying more UK stocks, with a few exceptions. What this means is that my portfolio is currently worth 109,000, almost exactly, of which a little bit under £15,000 of that is profit. So again, that feels pretty good. I've been adding to this a lot, so I prefer to look at time weighted returns rather than absolute. Because ultimately, I'm putting in so much capital that it's not the best measure. So anyway, this is my summary across those accounts that I mentioned. And yeah, so far it's looking okay. January, you can see, by the way, just to highlight the buy and sell there in the middle of January. I am quite an active trader, and I was just trying to kind of make moves in January. Some of them were good, some of them were bad. Overall, I would say it was probably about neutral. I find it quite difficult to measure those things, but yeah, so that's a very active month in January, though, as you can see. I basically bought and sold over a third of my portfolio value, so pretty big. Anyway, let's walk through it and look at breakdowns and etc. All right, so these graphs are a good example of something that just populates in real time. The top left here is my profit over time. You can see my profit over time has actually been fairly flat, I would say, for a couple of months now. If we look at the time-weighted performance, it is gradually eking up, but it's been a hard slog for about 4 months there, you can kind of see. Really since October. You can see my big drop on the blue line there. That's November. That's when the new variant came along, because I'm a little bit exposed in terms of recovery and consumer discretionary stocks. But it does now mean that I have overtaken the S&P again. It's had quite a fallback over January and February to date. Whereas my portfolio has been more or less flat over that time. And actually the FTSE 350, which had been lagging both myself and the S&P, has really been catching up, and to my surprise is now not so far behind the S&P 500. This bottom left here is something I introduced quite recently, and it's just my total portfolio value basically. So again, you can see here it's been a hard couple of months slog. I have been adding capital to this, which is the main reason why it's still moving up in the same direction. But yeah, it's not the easy money that it was in 2021 when I first started investing. So, oh, and by the way, I kind of left the 105,443 there. That will reconcile with my January close, just because it basically uses the same data table to populate. So that should reconcile. Yeah, and time weighted comparison is looking really good. I'm having to do this whilst FX movements haven't been very favourable either. And, again, I do have quite heavy exposure to, still 30% of my portfolio to the S&P, and a decent chunk of that is in things like tech stocks. I do also have a reasonable share in Disney, which helped, obviously, as well as some financials and healthcare as well. I think financials and healthcare do actually have some good value in the S&P. So that's been most of my historic focus. But again, with the pullback in the tech stocks, I have been buying, some semiconductors, some software, some, the big tech as well. So that's been gradually increasing my tech slice, as we'll see in a second. So like I say, honestly, on balance over the last couple of months, I'm actually really happy. I've kind of reeled in the S&P 500 and overtaken it again, and that's not a huge surprise to me. My portfolio overperforms when the S&P struggles. You can see in September when I first overtook it, again, I had a big stake in a company that had activist interest, so that also helped. But even still, I had some resiliency there because I was very light in tech. Whereas now, arguably, I have more exposure to tech, so I'm kind of feeling the pain a little bit more. But still, it's good so far. But again, I'm under no illusions at the moment that a lot of my outperformance in February is National Express, my largest holding, as we'll get to. I've made about $5,000 in total on National Express, so that feels really good as well. Yeah, so I guess I did manage to get my holdings under 30, and over the last few months, I've basically just been adding. I think there's a couple of reasons for this. Like, first of all, I grew increasingly uncomfortable with having a very top-heavy portfolio, and as I've been kind of redistributing some of those profits, I've basically just been opening positions in new companies. So that's contributed for sure. And also, like, the existing companies I have, the likes of like Microsoft or Danaher and Amazon, Google maybe as well. Like, I'm not 100% sure exactly how much money I want to be putting into them at the moment. Should I be averaging up or down? Is this buying opportunities? They still seem a little bit expensive to me on the whole. So, I've been like buying into sort of, Facebook is a new position for me. It's sort of bought after the earnings crash. CRM is very similar, Salesforce, as well as Amcor as well, a semiconducting testing company I'm bullish on because I think it's going under the radar. So that I've been gradually increasing my exposure there as well. So, yeah, I think the biggest change really here is my technology slice. When I was in September, this slice was something like 6% from memory. It was definitely in the single digits. So this has really been a notable change for me. I've also reduced my healthcare, increased my financials, and decreased transportation. But that whole slice is National Express. So, previously it was 25%. Now it's just 21%. And again, I would still say that's pretty top heavy. As well as, I've been broadening into UK construction, a small amount of REITs as well. I bought, actually timed them quite well. So that feels good as well. So yeah, like I say, I'm happy with how the pie is developing. When I first started investing, I think I had like ideas about, like very rigorous control points. But, I'm not a fund manager. I don't have to stick to, 20% tech or 15% healthcare, or whatever it was that I was trying to come up with, right? I don't really look at this slice until I do this at the end of the month. And then it's almost like an interesting thing to me, right? It's like, oh, yeah, I sold off some Bristol Myers. Oh, that's one of my healthcare slices gone down. Oh, yeah, okay, I bought some semiconducting stock. Oh, that's one of my tech stocks has gone up. So it's almost like a surprise for me as well, because I don't really look at this. It doesn't frame my investment decisions. But I do also like understanding where I am and, kind of just having some knowledge in that regard. So that's been the biggest change this month for sure. All right, yeah, and in terms of dividends, it's really nice to be getting them again. I mentioned at the end of December that I sort of missed dividends because in December I actually didn't get any. I wouldn't really class myself as a dividend investor, so although my year-on-year here, looks maybe a bit disappointing in first view, my portfolio has more than doubled during that time period. It's probably about 160% higher, something like that. My dividends haven't really gone anywhere. And that's, again, I'm not really pursuing a overall dividend or dividend growth strategy for my portfolio. I do certainly have some holdings that, like are higher yielding. But as an example, over January, I sold almost all of my EPD shares. So, that was a very significant yielder for me that would have paid me a dividend in February. It's just not really a huge consideration for me as a portfolio balance. Like I won't always make the right decisions, and in fact, I regularly don't. But if I believe that there's better money to be made elsewhere, I'll sell a dividend stock. It's just what I'll do. And again, I'm not saying that's the best thing or not, but it's just I guess, a reflection. But at the same time, I did realise that I did miss the dividends. And actually, in January, I picked up and opened a new position in Realty Income on a bit of a fall. So I got in at like the low 66s, so that felt okay. And so now I'll never have a month again where I don't have a dividend. So that feels pretty good. And I guess last of all, because now I have a lot of my exposure to UK stocks. UK stocks typically pay out only twice a year, typically an interim and a full is what it's called, and they'll typically be 60-40 or up to maybe a 70-30 split, and they're typically in sort of April, May, and then September and October. So I think I'll actually have a very different dividend distribution to what many people will with heavy US stocks, where it's typically quarterly or even monthly. So I'm really actually looking forward to kind of the April-May period when some of my UK dividend stocks, things like insurers, miners, those kind of real dividend powerhouses, you're looking in the high single digits for most of those I've just named, if not the low double digits. So I'm really looking forward to that time, because then I'll get a great cash injection. But it's not a primary driver for me. That said, like if I look at this, I've made like 2,500 almost on a 109,000 portfolio. So even that, in terms of an absolute yield, is something like 2%. So it's not too bad. It's just, like I say, it's not something that is actively driving my investment outlook, but at the same time, it's nice to reflect on the fact that that feels like 2.5 grand of free money, and that feels good. Basically, it's way better than I could get in a bank, and it's just nice to have, when my brokerage gives me a little alert and it's like, oh, you've got a dividend from this company. It feels great. So this month I've listed both my January and my February ones. Most of it, to be honest with you, is Bristol Myers, and then Games Workshop there toward the end. All right, so change of scenery for the last bit here, just because my wife and daughter came back home, so the living room is no-go at the moment. Honestly, this is more of the same in terms of the size of the portfolio. I'd managed to get this down onto a single list on the left, but I've had to redivide it out into two again. It's a bit of a mixed picture. I mean, there's lots of reds in here. There's a couple of reasons for that aren't, well, that are situational, i.e., the falling S&P, as well as the fact that I'm quite an active trader, so I don't tend to sit on sort of very large greens, from yesteryear. I've normally sort of sold up and moved on, again, rightly or wrongly. And then obviously my own faults here, like I actually quite like a lot of my holdings, like Gamma, I think is a real quality company. I obviously was too quick to buy a stake, but I have no concerns about it at all, and I actually continue to buy. Games Workshop similarly. Genius, I was a bit on the fence, but they had an investor day at the end of January that I thought was excellent. So now I have, I'm really quite confident, and averaged down actually into the $9.50 kind of region. So still pretty red, as you can see. But now I've increased my exposure there. And even like Polymetal, okay, I mean that's kind of fine. It's a commodity play, and it's somewhat of a hedge. And then if I look down here again, Amcor, I really like this company. I've got a $23 almost flat buy at the moment, and I'll be buying more under $21. And then the rest there kind of is okay, I think. New positions in quite a few REITs like Vici and Realty, and even a tiny one there in Macerich that I've been buying and selling since for a while. But yeah, broadly speaking, I like my larger holdings. I did have an even larger stake in Hollywood Bowl there, so you can see it's my number 7th largest, but I sold a third of my stake, about 27x, I can't quite remember. I have a 280 buy price here, or sorry, target price, I guess. And then it fell back down, so actually it felt really good, because I redeployed it into like JP Morgan, Goldman Sachs, made some good money there as well, so it was very quickly a nice snowbally kind of thing. And likewise, Bristol Myers, I used to have 350 shares in this at the highest. Now this is about 200 shares, but it's been very good for me, as you can see, and I'm up almost 2,000 on it. So I'm relatively relaxed about the large reds. When I first started investing, I had reds for National Express, Huntsman Corporation, and BMY. Made really great money on Huntsman, like over 4 grand. I'm making good money on BMY. I'm making good money on National Express. So again, rightly or wrongly, it's kind of reinforced that confidence. And even though I accept that I could have averaged into these a bit better, at the same time, I think that the companies are very good, and I'll make money on them in the long run. So no pressure for me to sell, and I don't feel at all like I'm just holding on to it for the sake of stubbornness or anything else. So yeah, overall I remain really happy with my portfolio. There's quite a lot on the tail ends kind of stuff here, and again, there's a couple of reasons for that. First of all, like I'm just gradually averaging into some companies. Like if you look at Alpha Wave, right, which is on the right about a third of the way down, that's been pretty red for me for a little while, and then it announced a chip making deal with Intel, and suddenly it shot up, and now that looks nice and green. But also a lot of these shares sit in my ISAs, so the tax efficient accounts. And at the moment, those are full, so I just don't have the ability to add capital to them to kind of build these stakes. So I'm having to kind of sell, and that's okay. I do also have an account outside of it as well, where about 10 of these companies sit, and that's where I'll be focusing capital until the end of March when the ISAs can renew again. But again, I'm not in a huge rush there. I didn't even add any cash in the latest week, so that's okay too. And if I was adding cash, it would probably be for things like Amazon, maybe Microsoft under 300, and Games Workshop. Those are the three that spring to mind from that. So I think that's where most of my attention is going to be going. But saying that, especially the ISA where my National Express sits, that's got Salesforce and Amcor in it. So, there's very likely going to be some buying in that general direction, as well as potentially Vicky as well. I really like that REIT, and I think at, about $28, it's a decent entry point. So there will definitely be some more trading. I'm not going to let you down in that regard. But until then, like, this is how my portfolio is currently going. So yeah, pretty happy overall. Challenging January for sure, but again, on reflection, I'm mostly happy with it. And February so far has got off to a great start. But again, if you look below the surface here, basically, you can see there's quite a few challenges that are being hidden. And I mean, not really hidden, right? Because I'm being very open about it. But it's kind of like smoothing out a lot of the turmoil and the turbulence that's happening in other parts of my portfolio. So it is what it is. Anyway, that's my run through. I'll try and do an end of February in a bit more of a timely way. But yeah, otherwise, I've been the Boss Hog. Thanks very much for watching, everyone, and good luck with your investing. Bye for now.